So, hello everyone. Today we have on the podcast Yash Modi. He is currently a credit and analyst at Blackstone Group. So, uh, like
Hi.
obviously, I mean, if he isn't well steeped in finance, I don't know who is. He's worked with the Bank of America, Merrill Lynch. He's also worked at JP Morgan. So, like a brilliantly smart guy, if I may say so. Right. And so while he is a credit analyst, he's also an all-time nerd, like most of us listening to this podcast. And he also knows a lot about private equity. So we've planned the conversation to revolve around private equity and credit analyst analysis, and also obviously his role as a credit analyst and what it takes to be one. So I'd like to start with that only, Yash. Would you mind guiding us through what, in very basic terms, what a credit analyst does?
Yeah, so I guess thanks for the invite for this podcast. I guess it is a good initiative by you so that I guess people have a kind of insight into what the real markets are. Because I guess when you are studying finance or economics, what the theory talks and what the practical world is, I guess there's a decent amount of difference between both of them.
Right.
So to begin with, I guess so I had started my career at Merrill Lynch, and I was
Mhm.
an investment banker there. I started as an analyst. So my main job was basically to prepare pitch decks. So pitch decks are basically, simply put, they are presentations, and
Mhm.
basically they are there to kind of analyze a particular investment opportunity. So whether it's a buy case or a sell case, or like sell case would be when you are holding an investment,
Mhm.
and buy case would be basically when you're looking at a granular level, that what investments can be made by a particular bank and what is the theme of yours. So most of the investment banks, they follow a particular theme when it comes to investments. So the theme could be a 5-year theme or a 10-year theme. The themes are basically like the big ideas, right? Like if you go to
Right.
see the big ideas for 2030 would be AI. Then there'll be what is research in the healthcare side in terms of oncology, and what do you say, DNA synthesis, basically how it is used in order to kind of reduce or predict better cases of basically predict cancer. And like there are AI models right now basically working in order to basically study the data, and
Mhm.
so that eventually we can predict these kind of diseases much better. So these are
Right.
the basically the big ideas what investment banks work on, and accordingly they make their investments. And so that is one of it. And there, and basically I was working in Merrill Lynch doing due diligence on such investments on a very granular level. So basically it would involve the analyst by themselves to go to a particular factory. Like say we are looking at a logistics company, we would actually
Mhm.
go to the to the factory. We see what would be the basically the employees, their skill set, and say we need to kind of optimize and make the particular investment, like make the particular investing company would be a company where basically you are deploying your cash and
Right.
making basically where the investment is being made. So we would be actually looking into the company at a very grassroots level. Like you actually need to go through and skim through the investor, basically the employees, and maybe you are the one who's actually making a decision that who would stay or who would not stay at the particular company, you know. And so that's what I did at Merrill Lynch. And usually, how it works in the industry is if you are in investment banking, it takes about a decent number of years, like a year, or 2 years, or 3 years, eventually to to get a break into a private equity company, because private equity is similar to investment banking, but
Right.
that's the buy side. Investment banking is considered to be the sell side, because most of the times investment bankers are looking for people to make those investments. So say you are a client, right? Like say you have a company A, and A required a certain amount of funding. So A would approach an investment bank, which would invariably go ahead and approach a private equity fund, like say a Blackstone or a Vista Equity Partners or KKR. And KKR would
Mhm.
basically have the mandate. That's called a mandate. So basically, a Merrill Lynch would go to a KKR and say that, okay, this is our opportunity. What do you think? And the
Mhm.
analyst at the private equity firm will basically do again an analysis on their end, or what kind of equity has to be deployed from their end to make their
Mhm.
investment, like kind of fructify their investment on a longer term basis. So
Right.
that's how the whole industry works. because you need a good amount of study because investment banking is where the real grind is. I'm not saying that there are shorter hours of private equity, but private equity is much more focused. Investment banking, you could be dabbling in multiple sectors. In private equity, you tend to be focused on the theme of the company. So right now, I'm working in Blackstone. So the overall genesis of the whole philosophy in terms of investments is basically that we bet on real estate. Since the land is scarce globally, and we do think on a longer term basis, the most valuable asset would be land. So which is why if you see globally, Blackstone seems to be doubling down on real estate, be it warehousing assets, be it logistical assets, be it commercial properties. So I mean, that's how this is on a broad scale on how we work and what we look at in terms of industries.
No, that was actually like a pretty good explanation in layman's terms. So, right, you work. We kind of understand how difficult it is to get into Blackstone, right? And so I wanted to know how you got into this, because for a lot of people it's just the money. So I mean, it's not a bad thing, but what was it for you? It was the money, the passion, a mixture of both.
Okay, so basically, it depends. So basically, how we look at joining such industries is it depends on your interest and your passion, right? I mean, if you do not like numbers, I don't think finance is your place, because invariably you are just dabbling into numbers. And if you want to grow in this industry, you need a very strong background in economics, because finance, like how we go to see is these two pillars of basically math, which is finance and economics. Finance is the quant. Economics is basically the story behind that quant. So that's how basically I understand both of them. So unless you understand an economic perspective of a particular investment, you will be just dabbling in numbers. You will be only a plain quant. So plain quant computer would just run the task. But the moment you bring in some amount of knowledge behind it and basically tell it to run a particular code or tell it like on what basis it should run that code is basically knowledge. Is basically the story on that number. So that is what we do in the private equity industry. We basically have a story on those numbers. We need to justify, right? How do you justify a particular number? So that number can be described by, like, say you want to make an investment in like how Shark Tank works, right? You go ahead and these people make a pitch and they go ahead and then you feel like, okay, this is a valuable investment. I should make an investment. I should go ahead and deploy some cash. And the person who would be pitching, he'll be like, okay, I have a 2x return, I see a 3x return. But that's a number. On what basis you prove that number is the story on that number, which is very important. And that will come only if you understand economics, if you understand demand supply, if you understand price elasticity, and most importantly, you have to understand at a very granular level how inflation and how interest rates work. And so basically, which is why I guess I recommend people whoever want have an initial plan to study abroad, that you should have a very strong economics background, because most of I have seen my colleagues or my friends or my juniors, they all go ahead and they want to study MS in finance or basically simple stuff like go ahead and just study numbers. But economics, I guess, is the branch which basically teaches you on what basis these numbers, like how you reach those numbers. So, and in India, how it works is global. So I guess India, the competition to get into such firms is brutal, because most of the times private equity firms are very lean, right?
Right.
So in terms of lean, I mean, like globally, Blackstone would employ only 3,000 people, and Blackstone is handling $500 billion in assets. But the number of people employed is only 3,000. So in order to beat that competition, you need to be best of the lot. And India, the thing is, say you want to break out in Blackstone in India. So how the recruitments work is that the fact that it's not like Blackstone has a bias towards IITs and IIMs, but the fact that they are invariably considered to be the cream of the country, right? Like say you get into IIT or so you only get there if you have like sheer gut and the determination, and you put in the work to get there. So for Blackstone, the job only becomes easier to recruit, because they know that okay, this institute has the best of the candidates from the country, so they would skim from there. because the fact that India produces 15 lakh engineers and about 10,000
Yeah, it
CAs,
doesn't make sense going
and
to tier one and
yeah, for
tier two
them to,
colleges.
yeah, so they need to zero down and they need to be faster on the recruitments, which is why they go and skim through best of the talents. They would recruit all India rank holders in CA examinations. They would recruit the top 10 of the IIT Bombay class, or they would go ahead and recruit the gold medalist at IIM Ahmedabad. So my
Hmm.
colleagues are from those branches. But how I ended up, I lucked out is because I did a bachelor's in science, BSc in economics and management
Right.
from London School of Economics. But so I did it from Bombay. So there is a school near Ecole Mondiale called Russell Square, which is basically an affiliate of LSE in UK. So although I
Okay.
started from Bombay, my degrees have been issued as an affiliate from the UK university, which is the London School of Economics.
Right.
And thereafter, my initial work ex began at Merrill Lynch. And what do you do at an investment bank? Kind of, I guess that's what helped me because it framed my career. Because I
Hmm.
ended up working on certain structured complex derivatives. It's called CDO, complex debt obligation. It's a particular kind of a bond, a financial instrument,
Hmm.
which is kind of mathematically complex to understand,
Hmm.
and it takes about decent amount of time to structure and make a certain product, which is invariably sold to investors.
Hmm.
And since I worked on this particular complex instrument, my I ended up being on the far end of the spectrum when it came to learning. My learning curve was very steep, and
Right.
thankfully, I usually mention that in my resume as an highlight in my career, because usually you don't get that kind of an experience at a very early age. I was lucky and I
For
was there
sure.
at the right time,
No, for
and
sure.
I guess that's how I kind of figured my way out through IB into P. Otherwise, it's other and abroad. If you go to see, say you want to get into a PE firm, I guess your primary goal should be kind of having a very high ACAD score, and
Obviously.
in your basically in your school and high school,
Hmm.
and thereafter, I guess as far as I know, in undergrad you can do internships in your fourth year and in your
Yeah.
third year, I guess. So I
Yeah.
guess that
Yeah.
should be,
No, for sure.
and I
Yeah,
guess,
I think
yeah.
that's a really good perspective because what the popular sentiment right now is you go get a core STEM degree, you do it like you do the most rigorous course out there, and
Mm-hmm.
then you do an MBA. So the MBA makes up for the economics part of your resume. And obviously, you don't study economics, but the financial side of it. And the STEM makes up for the rigor and the number skills you require. But this
Correct.
is a fresh perspective, so everyone listening should consider.
Yeah. So I guess this is, I guess, it's a typical straightforward path. Invariably,
Right.
what I mean, most of the people do in India is invariably they go abroad. They end up picking up a course, say would be a bachelor's in econ or math or even physics. And that like if you go to see my counterparts working in hedge funds, like if
Hmm.
you like right now, since everything is moving towards deep learning, machine learning, AI, and like having a very people, the private equity firms and financial firms are increasingly wanting to hire people who have a strong quant background. Like anybody who's listening right now and who is approaching grad school, okay,
Hmm.
and basically looking for undergrad programs, I guess I guess my only advice would be to pick a course which is high on quant and which helps you to dabble between both data analytics and gives you a good understanding of computational finance. And I guess there is one school, I guess, as far as I know, computational finance is there at Fuqua, at Duke, which is a brilliant course because they teach you computational finance along with economics. And so yeah, that's a good course because it's a combination of both. And I guess eventually, on a longer term basis, people who wouldn't be having such a background like in data analytics or even like how to make data better and efficient in
Hmm.
terms of its application, people who wouldn't have this background, I guess they would end up lagging behind. Like even right now, if you go to see, the trend is moving towards all of these courses because like even if you go to see most of the MBAs now, they are turning into STEM MBAs. Up until two
Hmm.
years back there were no STEM MBAs. Now they are understanding the importance because everything is invariably becoming much more like leaning towards machine learning, deep learning. Computers are kind of taking over
Hmm.
trading jobs. and when it comes to modeling structures and everything. Which is why, like, there was just a story. I remember about in 2010 or 11, Citibank had about 1,000 traders on the floor, and now they have barely 50 on the floor. Rest have been taken over by the machines.
Wow.
So increasingly, there is a trend that I don't see. That's why I'm saying invariably they're not saying that these jobs are going to be completely wiped out, but there is the only thing which will kind of invariably be a strong point would be a person who would have the ability to work alongside a computer, like say a quant guy who understands how to code and obviously has a background of econ. He would be an asset for the company. Because the moment you lose out on such skills right now is the time for you all to basically pick up on such skills. But the moment you lose out on such skills, you can become dispensable. The only reason for you to be at job and for a company to have you on board should be that you have certain indispensable skills. Like say you know how to code and at the same time you understand economics. You are an asset for the company when it comes to financial markets.
Right. So coming to say the more technical part of this podcast, getting into not getting into private equity. Let's just broach the topic. So, in the simplest terms, what is private equity?
So private equity can be considered as an alternative investment avenue. So if you go to see as investments on a larger basis, there are two kinds of investment. One is a straightforward investment class, which people like you and me can go forward and do it. Like say you have $10,000, you can go and invest in the share market, right? You can buy a stock of Apple or Amazon.
This is for more that's a retail individuals.
Yeah, this is a much more straightforward or conventional investment class. Basically, you going forward and say investing in the stock market or in the bond market or in the commodity market. This is straightforward. So what private equity is, it's on the flip side of it, which is an alternative investment class where basically certain sovereign funds are basically funds started by countries. Like say Singapore has its own sovereign fund called GIC. Say Abu Dhabi has ADIA, Abu Dhabi Investment Authority. So these are the funds started by the governments by themselves. And these funds, they source their money from basically revenues from the government's investments. Okay. Like say the Singaporean government, they have certain corporates, which basically say $100 million. They would raise these funds as their own GIC's own fund, and they would go and invest in certain companies depending on the theme. And as the fund keeps growing, they keep removing and adding their investments, and that's how the fund grows. So basically, on a larger basis, there could be sovereign funds, there could be pension funds, there could be HNIs. Actually, not HNIs, UHNIs, which is ultra high net worth individuals. Then there are family offices, like say the Walmart family, basically the Waltons. And these people are the ones who have surplus cash reserves, right? And so when you have say 100, 200, $300 million to invest, you're not going to go to a straightforward share market and like, okay, I'm going to buy this stock. You want a professional investment advisor who basically takes care of your money and who kind of assures you a certain amount of return on your money. So basically how it will happen is, like say private equity firm Blackstone. We would approach sovereign funds. We would approach pension funds. We would approach ultra high net worth individuals to raise funds. So like say we want to raise $1 billion. So we would approach all of these funds and we would have $1 billion in our kitty in the Blackstone fund. Now Blackstone will tell them that, okay, this is the benchmark return which I can kind of assure you that, okay, I give you 8% on your dollar. So basically say GIC gives me $100. I'll be like, I'll not guarantee it, but I have certain basically term sheets which basically tell you that, okay, your investment will be in a certain thematic portfolio. We will assure you certain returns, certain distributions by the way of dividends and all of that. And say that 1 billion eventually gets invested in different companies. Like say 1 billion, out of the 1 billion, say 100 million could get invested in Flipkart, 50 million could get invested in Swiggy, another 100 million could get invested in Uber. So that way, this the whole fund of 1 billion gets kind of invested in different companies, depending on the theme of the investment fund. And say usually private equity investments are on a long-term basis because we see a 5 to 7 year horizon when we want to invest in a company. So our investments are not near term. Like share markets and hedge funds are very much near. Like they have the profit and loss on a daily basis. They are mark to market almost on a daily basis. What we do is, like, say there is a company called A, and it's a pharmaceutical company, and we see a growth opportunity in it. So we will be like, and say they are making an oncology drug, which is eventually going to reduce the effects of cancer and maybe help you prolong your life. So basically, we see this as an opportunity. Okay, so we'll be like, okay, we will invest $100 million in this fund, in the private equity, in this pharmaceutical company. And then what the private equity firm does is basically it takes part or takes control of the management, or maybe imparts certain managerial expertise to the company, and makes the company much more lean. So what do I mean by making it lean is basically reduce its non-core assets. Like say the pharmaceutical company is also dabbling into packaging, or dabbling into, like say, general research, which is not yielding money, okay, like which is kind of rather guzzling cash. So we would kind of remove those divisions. So we would remove certain people which are not required, make the company much more lean and efficient, like a proper machine. And then invariably we would flip out the company after 5 to 7 years. Like say after 5 years, this pharmaceutical company has become a big name in the oncology division, and now it could be valued at $500 million. So invariably your investment of 100 million is right now yielding 500 million. And that could be after 5 years or 7 years. And depending on the investment team and of the investment committee at Blackstone, we would either take a decision to sell the company and the exits. And how we sell a private company is basically, these companies are not listed, right? Like if you go to see private equity companies the reason they call it private equity is because they are private. They're privately held. Yeah, publicly listed companies are ones which you can buy and share. People like you and me can buy and share. And so basically the only way and the dream exit for private equity funds like Blackstone is to have the company listed. So what we would do is So what we would do is take the company public in 5 to 7 years, and we'll be like, okay, this company was here 5 years back. Now it has this many products. Now it has this much market share. And it's a viable investment opportunity if you people want to invest money. So this is how we take it for an IPO. And basically that time the valuation would be say $500 million. So Blackstone would exit at the valuation of 500 million. So if you go to see, there is a 5x return on the investment. So maybe when Blackstone invested 100, now the investment is yielding $500 million.
Right.
So
but
and this 500 million, yeah.
Sorry, but these are say money making buyouts, and this is for companies that have the potential to do good, right? But what if we look at private equity as a form of an improvised bailout for bankrupt companies? Because say a private equity firm has an entire supply chain, like under its control through various companies. So if it has like an ecosystem of firms that contribute towards the production of cars, right? And there's a bankrupt company whose tires aren't being sold, right? So if a private equity firm takes them under their wing and makes them a part of their ecosystem, right? So it's kind of a bailout for that company, right? And the government loses almost no money because of all this.
Okay. So basically there are different kind of investment which a private equity fund would do. Okay. So there are certain firms which go after distressed assets. So what do you mean by an insolvent company or a bankrupt company is usually we do not ever go after a completely bankrupt company. We would go after a distressed company. So distressed company is basically a company which is not able to pay its debts, or it has a cash flow issue. Basically it has huge outflows and there is no cash inflow, which is why the company is distressed, because it is not able to pay its debt. So what a company would that time, a private equity firm would enter and basically say it's a viable opportunity for us, and say because of COVID or whatever the situation be right now, the company we are able to buy it out at a significant discount, because obviously it's not able to pay its debt, which is why we would ask for a huge discount on the purchase price. And basically that's when a private equity firm would enter, and it would take over depending on the type of investment, we would either take over the management or we would basically just impart expertise. And basically the whole idea behind the investment is to kind of make the company a much more lean machine and basically optimize the performance so that your top line and the bottom line is on the balance sheet is improved. Your non-core assets are basically disinvested, and you focus only on the core values of the company. So that's what I do technically. So I do not work in private equity specifically. I work in Blackstone Credit. So Blackstone Credit is basically certain companies which do not end up availing finance from banks. So because most of the time, say you have a company, you go to a bank, you'll get the loan. But say you're a distressed company, then the bank would not be willing to give you a loan because
Right.
it is not sure whether it will ever recover that fund. So
Right.
what they would do is that they would, but at the same time, a bank would be okay to give money to Blackstone
Yes,
because
because
okay,
you
so we'll
have
go to a bank,
credibility.
yeah, because we have the credibility. So we'll be like, okay, we go to Goldman Sachs, or we go to basically, say in India, the DFC Bank, where we'll be like, okay, we need $100 million. But at the same time, a research company will not get $100 million. So what we would do is, okay, like we'll go to a bank, we'll get $100 million, and we see a viable opportunity in the distressed company. We'll be like, okay, here is the loan, but the loan comes with covenants. The covenants are positive and negative. So by positive, I mean to do something, and negative means to not to do something. So not to do covenants are basically to not to take more leverage on your balance sheet. No more leverage, basically, I mean to not to basically burden your balance sheet with more assets. Don't buy certain assets. Don't take certain loans. Don't perform certain R&D activities. And positive covenants are basically only to focus on and to get certain things done. Like, okay, double down on certain products which are kind of helping your top line. Like, say out of 5 products, 2 products are only the products which are kind of working for you. You make sure that okay, only these 2 products are doubling down on. Like, basically, you what do you say? You tell the company that okay, you only focus on these 2 products. Your whole idea behind this loan which you give to that firm is to basically make it much more efficient. Like, okay, you focus only on, you play to your strengths. That's it. And that's when all of, so basically there is a structure in how we invest. There's something called mezzanine financing. There's something called subordinate debt. And all of these are basically different structures, which is much more technical right now. Basically on what grade your investment falls into. So it could be the equity grade. Equity grade is basically where you take a stake in the company. Like, out of the 100%, what they do in Shark Tank, right? They take 20%. That's an equity. Mezzanine capital is basically subordinated debt, which could be convertible into an equity instrument later on, depending on what basically your structure is, or it could be converted into preferred stock of the company. And basically, it is a grade above the equity, and it's kind of risky because it is convertible. It is not ready equity. So, and most of the time, that's what we do on the credit side, is we go ahead with mezzanine financing or some kind of hybrid capital structure, which we are working on, depending on what the company needs. And those are basically specific to the company. So, yeah.
So are a majority of buyouts absolute, as in completely funded by Blackstone, or are they sometimes leveraged by, say, debt or equities?
Yeah, so how a private equity works is basically it's LBO, is leveraged buyouts. So leveraged buyouts are basically how it works. I'll just give you an example. Like, say a particular investment requires 100 rupees.
Right.
But obviously, the Blackstone would not be willing to invest 100 rupees because it wants its resources to be deployed in multiple places. You can't have all your eggs in one basket, right? So what Blackstone will be like, okay, just to ensure or just to be kind of show credibility for a particular investment, they'll be like, okay, and sometimes even the laws ensure that okay, the firm which is going ahead with the investment should have certain skin in the game. So Blackstone will be like, okay, I will put upfront $25 out of the $100, and the rest 75 is leverage. And the leverage could be by the way of a fixed note. A fixed note is basically a fixed income instrument, basically a loan, which basically you kind of raise funds through the sovereign fund, which I say sovereign funds and pension funds and everything, and you promise them a return. You are like, okay, I'll give you 8% on your dollar. And so what the thing is, so say Blackstone has gotten 25 rupees of its own money, and the rest 75 is leveraged. And now the onus is on Blackstone to churn, because you need to give the investor 8%, right? So you need to make sure that the company which you are basically running or where you have invested it's basically doing as per your needs, because at the end of the day you need to pay the investor, you need to give him his return. So then your investment committee, then your management committee, and obviously the investee company, you all have to come together on board and be like, okay, this is our goal, our 5-year goal, and this is how we will achieve it. And on the longer term basis, like say now the company is worth $500. So now Blackstone's investment of 20, and you do the pro rata, right? So which was 25%. Now it is 25% of the 500. And technically, the investors would keep still getting 8%. But if you go to see, the distributions are huge for Blackstone, right? Because Blackstone invested 25. Now it has 25% of $500 of a bigger fruit. And for the investors, they got the fixed return. So everybody's happy now. They got 8%. Blackstone got a 25 to 5, basically a 4.5x return, and now everybody's happy.
Right.
So that's how the investment works. Usually, most of the funds work according to such a structure. Nobody puts their entire basically corpus in one investment, because you need your corpus to have. You need to be open to opportunities, right? So that's how it works.
So is one selling point of private equity also the fact that it keeps your investments and company activities away from the public eye? Is that an important factor, or is it something just arbitrary?
I didn't get your question. What do you mean?
So if a company were to be publicly traded, right, it would not only it's all the investment into it, the promoter's share and whatever would be open in the public, right? But when you're dealing with private equity, that's something you can abstain from. So
yeah,
that's a good proposition for firms, or is it something which is minor and not really important?
So it's debatable, but most of the times a company intends to be private. It's only when they cannot raise money is when they go public. I mean, usually private firms have lesser compliances because they do not need to report on a daily basis to the exchange. Because the moment you are in the public purview, like say you are listed, you are responsible to a host of shareholders. You are responsible to the regulatory authorities. You are responsible for your actions. So basically, you are in the public eye since you are dabbling with public money. So the moment you involve public money, you are responsible. Moment you're at the same time, when you're private, all you're doing is you're handling your company. It's like a private business, right? Like say your father is running a business, he's not responsible to somebody else right now.
Exactly.
But moment he brings in public investments in his company, he's going to be answerable to the other investors, he's going to be answerable to the shareholders, he's going to be answerable to the regulatory authorities like the RBI, the SEBI, and in the US it is the SEC. So usually these are the compliance issues which come into the picture. But on the other side, when it comes to private equity firms, the only way the best of the exits come through IPOs is basically because at the end of the day, the private equity fund doesn't want to run your company. It is not in love with your business. It is in love with money. At the end of the day, it wants returns. So it will make sure that your company is a lean machine and have it listed in 5 years or 7 years. That is the dream exit for most of the private equity firms, to go for an IPO. Like the Snapchat, Amazon. If you go to see all of these firms, they keep pushing the promoters or the investors of such a company to go ahead and get listed. The moment you get listed, you have an exit. You have an exit purview. Otherwise, there are multiple covenants which come into the picture which do not allow you an exit when you are not listed. So that's basically the most important prerogative for a private equity firm is for having a wonderful exit at the IPO. And other ways which you can exit an investment is basically secondary sale. So secondary sale is basically where another private equity firm or another company in that particular domain, like say you're in the pharmaceutical industry, and say Novartis likes your company and Novartis finds your research very promising, they'll be like, okay, I'll buy you out. Otherwise, even a secondary, like other private equity firm who sees like this is a viable opportunity for the next 10 years, he might come and like say KKR. KKR will say KKR is invested in Blackstone's investment company A. So Blackstone is like, okay, I'm done with this investment. I do not see it in the longer term, or my vision has changed. My investment is I am interested somewhere else. So I'm going to exit. So they'll be like, okay, they will sell the particular stake to KKR. So these are different ways. So there are most of the time there are two ways. One is an IPO, which is a primary sale. Secondary sale is basically to certain funds or certain company in that sector, whoever is interested in your product. That's all.
Okay. I also had one question. Are a lot of investments of the active kind, or are they more of the passive kind, like where the management is where you're just the financier rather than taking over the management of a
So it's a two-way street. Depending on the life cycle of the company where we enter. So usually like funds like say venture capital funds, right?
company?
Venture capital funds, they come with the prerogative to only invest their money. They are not interested to run your company. But say a private equity firm, they are taking equity in your company. So at the end of the day, their returns are returns, and their interest is invested in your company. So they would basically be incentivized to run your company, or basically ensure that the management follows a certain path through covenants. Through basically when you give the money, you tell them that okay, you do certain things in such a way, and they will do it because this is all according to a term sheet, which is basically negotiated prior to the investment. A term sheet is basically certain do's and don'ts in a layman's manner, but they are much more complex in terms of what a company can do and not do, and like say guarantees, warranties, representation issues, certain patent issues. Like say we are investing in an AI company, and the AI company is only doing well because of say certain key person, like say a person A who has a brilliant skill set when it comes to developing AI. So Blackstone will ensure that okay, this person cannot leave the company until we exit. That could be a clause in the term sheet, you know. So most of the time that's how it works, and that is most of the time it's active, right? A passive investment usually is done by like sovereign funds because they are not interested in midterm, near term. They are invested for a very long term basis. Their investment horizons are 10 to 15 years. Like if you go to see sovereign funds, like say, and all insurance companies, their investment purview is like 10 to 15 years down the line. So they'll be like, okay, I find HDFC Bank a brilliant company, and I see India's middle class to be growing and getting only aspirational in the future. And I find India to be a brilliant place to be in 2030. So they will not mind investing it right now, because they, irrespective of whether COVID happened or not happened, or what happened right now in India or India attacked Pakistan, irrespective, they are looking at the ultra long term base of 10 years down the line. So at 10 years, all of these blips don't matter. So they are into passive investments because they are not actively managing them.
Right.
They're only basically there, they invest, and basically they sit through the whole cycle of that investment. And active is basically, but that depends. Most of the times, there are all different private equity firms which invest at different life cycles of a company. It could be active, it could be passive. Yeah.
Coming to the point of aspiring Indians. So I completely understand that private equity is more of a game for high net worth individuals, right? There's no denying that. But I don't know why, I want to know why regulation makes it such that, mutual funds can't invest too much in private equity firms. And so, like, is there any specific reason for it? Is it a very high risk instrument
Yeah.
investment?
So private equity, the reason it's called it's a high risk investment is because first of all you need a professional investment advisory team to go ahead and make that investment. At the same time, say you have money, right? Say you have $100 to invest, and you are a retail investor. For you to invest, the safest place would be from the regulatory perspective. Okay, like say I'm talking from the perspective of SEBI, which is a regulator in India for investments. So from a regulatory perspective, the regulator is interested in taking care of the investors. So you are a vulnerable investor, correct? Because you are not open to all the information which a professional investment advisory team like Blackstone would have. So since you are a vulnerable investor, they want to protect your interest. So they will make sure that you only invest in a fund, a mutual fund basically, which basically discloses what they are doing on a daily basis. Like a mutual fund is a highly regulated and a highly compliant industry, when it comes to basically making their investment. Because if you go to any website, you can see what their holdings are, how much are they investing in that company, all the way up to the very point. Like, okay, they're investing 7, 8, 9, 6 shares in this company. They're investing in 50,000 shares in this company. So you know to the very point that, okay, where your money is going. So this is from the regulatory perspective, is why they want you to protect you. Because the moment you go to a private equity firm, like say you come to Blackstone and you're like, okay, 10 lakhs. I give you 10 lakhs. But you don't know where your money is going, right? Because you are vulnerable. You don't know. You will not know that, okay, why is Blackstone investing in this pharmaceutical industry? Because that pharmaceutical industry will not have its records in public domain. Like you will not know. You will not be able to access the balance sheet. Like, say tomorrow you want to know why. Yeah. So say tomorrow. Yeah, so you have to look at it from the regulatory perspective, because say tomorrow Blackstone takes your money and they don't disclose to you that where they are investing, and then you have no idea. Even say we tell you we have invested in this pharmaceutical company, and you have no idea what the company does or what the company's past is or who's running the company, because all of the details are not in the public domain, right? Because the company is not listed. So if it's not listed, you don't have the details. So technically, you are just investing blindly, and you never know what happens to your money, right? So that is what happened to the dot-com bubble in 2000, basically, because people just invested in companies and nobody knew as well. Like if you have seen this movie, which was this one, I guess, Wolf of Wall Street. This guy is selling investments in a company which is running out of a garage, and with the garage shut, there's nobody working. And if you call the landline, a grandmother picks up. And he sells that investment as the next big thing in the future in the defense industry. So moment you don't know where your money is going, you are bound to kind of be fleeced, which is why the regulator doesn't want you to invest in certain things, which basically they think are not in the public domain, and your money could be basically misplaced or wrongly invested, and you will lose money. And then invariably, you will file a suit that, okay, how can you do this? So in order to avoid all of this stress, they allow the retail investors to only open to a certain kind of investments. But say you are a high net worth individual and you have that kind of money to invest. So then you can approach an investment bank or you can approach a private equity firm. You can be like, okay, I have this much money. And because at that stage in your life, like say you have 100 CR in your pocket, then you will only have that when you have a successful business running, right? And you will be like, okay, I have this surplus cash with me. I'm going to park it with Blackstone. Blackstone has assured me 8% return. I don't care where they invest. I just want my 8%. So that also there are certain kind of people who do that. Those are UHNIs because they have $1 billion family houses and they have surplus cash. So they have those kind of investments. So it depends on your investment appetite, your risk profile, and what you want to do with that money. So yeah.
So I guess this next one is the fun question. So from a Wolf of Wall Street, so I kind of feel that PA is like the investment banking of say the 2020, right, or even a bit before this. So is a PE firm? It's lean, but is it anything like the mortgage desk pre 2008? Like, is it just money being minted every second, or is it more sober in that sense?
So I guess all of this has changed. I will not deny that there are certain discrepancies across markets globally because greed has always existed, and I guess that is a difficult concept to kind of deal with right now. But on a larger basis, systems are much more compliant now. Like if you go to see the compliances which were there in 2000 and what they are in 2020, it's a host of a difference. So I mean that's so, which is why I guess no, investments right now and investments back then were very different. And so I mean yeah, so on a larger basis, I guess the systems are much better, are in a better place as they were back then.
Okay, and irrespective of this, so this is an observation which I think I've made, which it could be wrong or right. It's up to you. So after the West, after a few years after the West, we kind of pick up, right? As Indians, we pick up. So like first, it was a wave of startups over there. Now it is in Bangalore. They got into different diverse financial instruments when we brought it here. So private equity is already boomed there. Do you think India is set for a boom in private equity, or is it booming as we see?
So basically, if you go to see in the India perspective, there are the number of startups which are coming on, I guess, the host of sectors, like say it be healthcare, say it be AI, say it be education tech. And I guess all of these sectors are only up and coming. Because if you go to see, India has, I guess, grown in last 15 years from 2005 to 2020. There has been a huge amount of difference of the people are much more aspirational now. The middle class is much more aspirational. They want to. I guess India is poised for a brilliant growth spree from now to maybe like another 10-15 years, because I see because we have all the main advantage that India has is the youngest population in the world. And when you have such amount of human capital, if well utilized, the growth is unimaginable. So, and also the number, because India has the largest number of software coders in the world again. Like every year, say out of 15 lakh engineers, even if there are 5 lakh engineers which can code very well, it's a huge impetus to the engineering capital, human capital. So, which is why I see, because in the West, those markets are very mature. Because I guess India, in terms of regulation, in terms of compliance, and I guess only place where India is lagging is the regulatory issues. Because as an associate who I work into multiple investments, all I realize is the Indian markets, rather they have the intention, but they don't have the execution skills. So we want to grow faster, we want to have investments in the country, but at the same time we are not very much willing to basically, what do you say, have the necessary execution in place. And it could be because of corruption, it could be basically just not having the things in place, because you say something, you do something. Like say how Modi ji, right? Narendra Modi is like, okay, ease for business, ease of doing business in India, bring money in India. But at the same time, they are not in sync with the Securities and the Exchange Board of India, which is the governing body for investments. Because if you go to see, there is no certainty for a foreign investor to keep investing money in India, because the laws keeps changing. They issue notifications, they issue circulars, which keep changing the investment guidelines almost every 6 months or every 3 months. So moment an investor would be only willing to invest in a country when he sees certainty. So I guess India has an intention, but obviously execution should be in place to kind of give an impetus. But yeah, I guess private, yeah.
Intention, I guess, yeah, overcoming that inertia of bureaucracy is a big factor. I completely agree with you on that.
Yeah, so I guess there are certain places where India lags, and that could be only on the execution side. Because if you go to see the laws and everything, all are pretty much broad based, and all are there to kind of cover almost all gaping holes. But execution is where we lag, and I guess maybe we are getting there, because I guess one thing which the Modi government has done is brought in certainty. Because the moment you have a stable government, they can push through or maybe even ram through reforms.
Right.
So that way, I guess that's one good thing, is to have a very stable government in the center. And I guess the execution will, I guess, fall in place, hopefully. And I mean, so I guess the private is only, if you go to see the FDI investment, Asia is the largest kind, the country to receive the largest FDIs is India.
Right. Yeah, so it's a land of opportunities.
Yeah.
So I guess last question. Now I hope you have fun answering this one. So you're young, right? I mean, as a young individual, what would you find more exciting and / thrilling? Let's forget about all the rational aspects of it, like job safety and future prospects. Just on a daily basis, what would one find more interesting? Public equities or private equity?
I guess I would lean towards public markets, because there is a certain amount of thrill in the public market side, because you see your P&L, you're basically your profit and loss on a daily basis. Right. So, and that's a thrill, right? Like say you invest 100 by evening, it's 105 or it's 95. So that's a thrill. And basically all the youngsters right now, or not even youngsters, everybody wants to just make money, right? Like quick money.
Right.
And everybody just wants to get rich quick. And that is like the theme behind everybody. Like say you're working in computer science, or working in tech, or working in healthcare. Everybody just, I guess, it's maybe being too generic, but I guess that's a fair kind of a safe statement to make, that people.
No, it's a fair assumption.
The one thing which drives a huge motivation is money.
Money, yeah.
And when it comes to investment themes, be it public or private, I guess money obviously I guess is there a fair part on either of the sides, be it public or private. But the thrill I guess comes through trading, or maybe seeing your investments almost on a daily basis. So it's also a very stressful job, basically, because you need to invest change in front of your eyes, and you can see what is happening. Like where you can change if something doesn't go away, or you see it on in the evening, right?
Right. Yeah.
The market, something happens, or they say Pakistan bombs you, the markets could go against you. So then you are $80 down in your investment. So that's the thrill, I guess. So I do lean towards that side, but it's a highly stressful job also.
Right. All right. Thanks a lot for giving us this time. It's just been a very insightful conversation, and I've had a lot of fun and got a lot of knowledge about how the world, the finance world and private equity world is actually working right now.
Yeah.
So thanks a lot.
Yeah. Thank you so much for having me. I guess it was good fun for me as well, as this kind of is very interesting for people of your age, kind of, because I remember when I was your age, I had no idea of finance. So I didn't even know what private equity is when I was your age. So I guess it's a big deal, I guess, that you people are kind of looking into it, and I guess shows a lot how passionate you people are about all of this. So yeah, I guess good luck to you all. And I guess also a happy new year to you and everybody watching this.
Yeah.
Oh, yeah.
All right. Bye.
Thanks. Yeah.
Bye. Take care.